Let's assume that you came up with a smart idea and you would like to start your own company. So in order to start your own company, in order to start producing, what do you need? You need land, you need buildings, you need machinery and equipments, you need cars, you need computers, you need technology. So all this are called what? Are called assets. And what do I mean by the word assets? This is what the firm owns. So the firm owns the land, building, machinery, equipment, raw material, technology. So let's assume that this project will cost us $100 million. From where will you get this $100 million? You will use your savings. So let's assume that you have a savings of $30 million. So we call it equity, which means that you are the owner of this project, and that's why you put your savings of 30 million into this company. But still, you need an extra 70 million. From where will you get this 70 million? You will get a debt. You will get a loan from a bank of 70 million. So what do I mean by that? This is what the firm owes, which means the firm needs to pay this amount of money in the future. Equity, this is the value left for owners, shareholders. That's why we call it residual claim. So debt plus equity, 70 million plus 30 million is equal to 100 million. Therefore, this financial statement for any firm is called what? It's called balance sheet. Why do we call it a balance sheet? Because it must be balanced. Our assets must balance our debt and equity. Therefore, if we're going to draw our magic box again, this is our assets financed through debt and equity. An example of debt is a loans, which means you borrow from banks, or bonds, which means the company borrows, but they borrow from the public. A company will go to the public and tell them, okay, if you put your deposit in a bank, how much interest would you receive? 2%? Lend me your money and I will give you a return, which is 10%. Therefore, some individuals, some institutions will buy this corporate bond. So this means that the company started to borrow from the public. When we talk about equity, we talk about shares. And when we talk about shares, we have two types of shares. We have preference shares and we have ordinary shares. So for preference shares, they have one major advantage, and that's why we call it the preference treatment, which means they get regular dividends. When a company makes a profit, the company will distribute part of this profit as cash dividend to owners. So this means that every year or every 6 months, the preference shareholders will get this dividend. What about ordinary shareholders? Even if a company makes profit, is the company obliged to distribute dividend to ordinary shares? No, because the company might say, okay, yes, we generated high profit, but we prefer to keep this profit within the firm in order to reinvest it, in order to grow and expand. Consequently, they're not going to distribute dividends. Here it is considered optional, non-compulsory. So I would like to know what are the major differences between debt and equity. I would like to compare between debt and equity, and then I would like to get an example of debt, such as bonds, compare it with an example of shares, which is ordinary shares. So let me draw the magic box again. This is asset financed through debt and equity. In case of bankruptcy, let's assume that this company will go bankrupt. Who has a priority to get his money first? Debt holders. So if the company will go bankrupt, if the company is financially distressed, so we have to pay banks and debt holders first. And then if there is any money left, it will go to equity holders. Consequently, which one will have a higher risk? If this is debt and this is equity, which one will have a higher risk? Equity will have a higher risk compared to debt. Why? because of, in case of bankruptcy, debt holders will take their money first. And if there is any money left, and usually in case of bankruptcy, there is nothing left, which means equity holders will get nothing or will get a very small amount. Therefore, our expected return, which one should have a higher expected return? The one with the highest risk or lowest risk? The one with the highest risk. Consequently, equity should have a higher expected return compared to debt. For example, if you go to the bank and you get a loan for 10%, for shareholders, they would claim a higher return compared to 10%, such as 14%. Therefore, if I would like to compare between debt and equity, in terms of advantages and disadvantages, you will discover that the advantages of debt are the disadvantages of equity, and the disadvantages of debt will be the advantages of equity. For example, we said in case of bankruptcy, who will get a priority to get his money first? Debt. Therefore here, priority in case of liquidation. If the company will go bankrupt, they will get the money first. Therefore, what will be the disadvantage of equity? In case of liquidation, in case of solvency, in case of bankruptcy, shareholders will get the residual claim. What do you mean by the residual claim? If any money left, they will take this money. Then let's talk about another advantage for debt. They have a high or low cost of financing. They said because they have a lower, they have a higher risk or lower risk. So here we know that they have lower risk. Here they have higher risk. If they have a lower risk, so what will happen to their cost of financing? They will have lower cost of financing. Here, a disadvantage of equity, they have higher cost of financing. Then, an advantage of debt. Anytime you take a debt, you need to pay interest on this debt. This interest is tax deductible. Interest is tax deductible. So what do I mean by tax deductible? It means that anytime you take more debt, you'll pay lower taxes. Consequently, you will generate higher firm value. Then let's talk about the major disadvantages of debt, which will be the advantages of equity. When we take a loan, can we take a loan forever or for a short period of time? It's for some period of time, for 1 year, 2 years, 3 months, 5 years, 10 years. Therefore, here we take a loan for finite period. While anytime you put your money in a company, this company will stay permanently unless you would like to sell your part of ownership to another investor. Therefore, this is considered permanent source of financing. Anytime you take a debt, what do you need to pay? You need to pay debt service. What do you mean by debt service? Anytime you take a loan, for example, you need to pay interest on the loan and part of the loan, which we call it principal. Therefore, you need to repay your debt back, which means it will affect the cash flow of the firm. So every year, a firm must generate enough cash to repay the debt service in terms of interest and principal. While for equity, if a firm doesn't generate high cash flow, do they need to distribute any dividends? Are they obliged if they have ordinary shares? No. So this means that dividends are optional, or we call it non-compulsory. A firm is not obliged to distribute dividends. What is another disadvantage of using debt? If a firm gets too much debt, for example, 80%, 90%, 95%, what will happen to the firm? It will increase the probability of bankruptcy, which we call it financial distress. So this means that anytime a firm takes too much debt, this means that one day we might wake up and the firm went bankrupt. It doesn't exist anymore. Let's return back to our example here. We have for debt, we have loans and bonds. We have for shares, we have preference shares and ordinary shares. We said a general rule, debt will be paid first before equity holders. But in debt, we have loans and bonds. In shares, we have preference shares and ordinary shares. So in case of bankruptcy, who will get his money first? Loans will be paid first, followed by bonds. Third one is preference share. The last one is ordinary share. And please note that we use American terminology and the British terminology. Ordinary shares are American terminology. The British one is common shares. They're exactly the same. And you can use the word shares or stocks. Preference share is exactly the same as preferred shares. You could use the word stock as well.